Hi everyone, welcome back to my channel, and I know it's been a while, but I just want to dive straight into it and get going with the content today. If you don't remember me, I'm Thabi aka Thabi Mbonambi, and today we are doing Consolidated Financial Statements, the introduction. Previously, we would have done IFRS 10 dealing with the power over the investee, the exposure to variable returns, and the ability to use that power to affect the variable returns of the investee. So that is literally IFRS 10 just summarized into one paragraph. Now, let us get into what happens when you meet all three criteria of IFRS 10. How do you then consolidate? Proforma journals. So a lot of the time you're tested being asked, what are proforma journals? Perform the proforma journals for P Limited that has purchased S Limited. So that's exactly what we're going to do in this video. Proforma journals boil down to consolidation procedures. So after you've calculated your goodwill, after you've calculated everything, you now need to know what to do. So there are three types of proforma journals that could be asked of you, but I'm only going to cover the first type today, and that is the at acquisition proforma journals. Why we do proforma journals is to let our examiner know that you're able to combine similar items in order to prepare financial statements for one consolidated reporting entity. Remember, they have met the control requirements. We've determined that they control this entity. So what would you do in a financial statement if you're eliminating? So this will be covered in this video of what you do in a statement of financial position, when you are given a statement of financial position, and how you will be consolidating at acquisition. Remember, this is an internal thing. What you present to the investors is going to be on an external basis. So what happens for the parent and the sub, what happens between those two people cannot be combined. You would have to specifically take what happens for the parent, what happens for the subsidiary, combine those, and report externally where the investment in the subsidiary no longer exists. And this is what we essentially call elimination. So how do we actually pro forma? Firstly, you add the similar items together. You know that certain assets such as land, such as property and equipment, assuming there is no intra-group transaction, which will be covered in the next video, you would have to take the land of the parent, the land of the subsidiary, add those together, and you will effectively get to your totals. The examples you'll find in your tests and exams will pretty much contain intra-group transactions also, but you'd have to eliminate those. As you know, and as I just said, we are reporting to external stakeholders, so we cannot show internal things in our annual or consolidated rather financial statements. Inventory, equipment, intercompany loans, those are common things that are tested when you are doing intra-group transactions. And I'm going to put in something at the end, which is homework for you all, to actually track if you know each and every type of these intra-group transactions. One last thing, equity. In this part, only the parent's equity portion is recognized and the subsidiary's equity is always eliminated, because from an external perspective, the parent and the subsidiary are one, so you cannot invest in yourself. Non-controlling interests are literally the only portion of the subsidiary that's recognized in the statement of changes in equity upon consolidation. Why? Because non-controlling interests are literally the interests in the subsidiary we do not control. Literally today, sit back, relax. It's just the basics of Proformas without intragroup transactions. So, as I said, the consolidation types effectively boil down to 3 scenarios. These scenarios will be combined into one question in your consolidation tests and exams. I don't even care what they're testing, but I know it's going to be combined into one thing. Firstly, it's the carrying amount of the investment in subsidiary that you always have to eliminate. You remove this from the parent's portion because, as I said, that arises on business combination. I repeat, NCI is shown separately in the statement of changes in equity. And then lastly, intragroup balances and transactions are eliminated. Obviously, I did not finish my sentence, but we will not be covering this in this particular video. So, we have the calculation of goodwill. As I said, that's the first thing you do. In my last video, I spoke to you and I said, you take your consideration and you take your net identifiable assets, and the difference between the two will either be your gain on bargain purchase or it will amount to your goodwill. More likely than not, it will amount to a goodwill transaction, but just in case, I need us to understand what goodwill and bargain purchases entail, and that will not be covered in this video. Remember, we're doing simple examples. We're at the basics right now. So we have P Limited, which is obviously the parent. I'm an accountant, so I'm not really creative. And then we have S Limited, which is the subsidiary. And these companies both have assets, both have liabilities, both have equity. So now what do we do upon consolidation? So here's the fact pattern. On the 30th of June 2023, P acquired S. There is no mention of a percentage. I'm going to take it as though they acquired 100% of S. Do not assume things, and if you assume something, write down your assumption in a test or exam. I.e., I would say percentage not specified, therefore 100% acquisition assumed. You'll never get 100% acquisition, but just as a note and as exam technique, just do that. But on this date, the balance of the retained earnings was 8,000 Rand. This is on the 30th of June 2023. And as you can see, our year end is 30 December 2023. So 6 months have passed. But there hasn't been any change in S Limited's share capital since the date of acquisition. From this statement of financial position, we can obviously now determine the purchase price because the investment in S is recorded by P Limited. P Limited is the parent, so their investment in S would be the cost that they paid to acquire the subsidiary. It is 88,000. How do you then determine your net identifiable assets? Net identifiable assets are represented in its most simplistic form without fair value adjustments. They are represented by your share capital and your retained earnings, so your equity line items. Net identifiable assets are represented by their equity. So retained earnings are 8,000 Rand, and the share capital, because we were told it has not changed, is 80,000 Rand. Remember, this is at acquisition, so you're not going to take the retained earnings of 15,000 Rand because that is the retained earnings at 30 December 2023. We are told that on acquisition, the retained earnings were 8,000 Rand, so that is the figure you will take to determine what your goodwill is. Hey, wait a minute. Your purchase price is 88,000. Your net identifiable assets are 88,000. So let's start with that. Is there goodwill? Pause this video, answer yourself, and then come back. Okay, I'm not going to pause, but you can pause the video. So obviously there's no goodwill in this one, and I did repeat this example just in case you want to take a screenshot of anything. But what we effectively do, and I did not draw an AOE because this is quite a simple example. This is just to walk you through how to do pro forma journals. So share capital, please put SOFP in here. I did not because clearly I didn't know what was cutting, but I feel as though you won't get the marks. I don't feel as though, I know that you will not get the marks if you do not put what primary financial statement this goes into. So on the 30th of June 2023, P acquired S Limited, and we can see that the investment in S is now being de-recognized. Remember, it's an asset, so assets are increasing on the debit side. So we now reduce our investment in S to 0 for the purposes of consolidation. As you know, equity line items are credits, but we are de-recognizing the equity of the subsidiary because we do not have an investment in the subsidiary from an external stakeholder's perspective. And don't forget your narrations, please. So this is what your journal essentially looks like. Debit share capital, debit retained earnings, and credit your investment in S. So now let's do another example of having a partially owned subsidiary. Assume almost the same facts as before, except now the investment in S is 64,000 shares. So in a normal test and exam, I wouldn't have told you that P acquired 80% of S. I would have left you to deduce that because S has 80,000 shares, of which we bought as P 64,000 shares. So 64,000 divided by 80,000 gives you 80%. So I wouldn't have told you that. But yeah. And on this date, the balance of retained earnings was now 7,500. Again, there's been no change in S's share capital since acquisition. But now we bought 80%, so there's obviously non-controlling interests. How do we measure those non-controlling interests? Well, IFRS 3 gives you two methods to allocate the non-controlling interest proportions. You can either do it at its proportion of net identifiable assets, meaning that you take the equity and you multiply it by whatever percentage NCI has, and in this case, it is 20%, or at its fair value at acquisition. If you are buying a business and it's at the proportion of equity, that means that no goodwill for you will arise over that transaction because you do not own the equity. That is why when NCI or non-controlling interests are measured at the proportionate share of the net identifiable assets, you do not include goodwill for NCI. However, if NCI is measured at fair value, that is the fair value of the assets, of the net identifiable assets rather, which grants you a certain premium in terms of your control of S Limited. Therefore, you are entitled to the goodwill and the goodwill percentage that arises upon acquisition of a subsidiary. So if you're NCI fair value, you do add in the goodwill. If you're NCI at proportionate share, you never include the goodwill. If that doesn't make sense, let me know in the comments and I will clarify. Let's get on how to draw an analysis of owner's equity. So I've seen so many students stumble and fall when it comes to analysis of equities. So I'm hopefully going to find this in the next slide. No, I did not. I'm hopefully going to see this in here. But where we start off is that we start off with our at acquisition. So at acquisition, I expect nothing to be in the since column, because the since column represents acquisitions that, or rather transactions that have happened on acquisition from after the acquisition point to before the current year has started. The reason we separate these two is because profits will never go into retained earnings in the current year. So your debit will not be, or your credit rather, will not be profit for the year, but your credit will be retained earnings for periods before the current year. However, when you get to the current year, it's a completely different account. Remember how in first year you closed off profit for the year into retained earnings? That is it. It is closed off. It is cut. It is finished at that point in time. So then what I wouldn't expect to see is you having a since amount at the beginning, and you have to split the two because retained earnings might be different for whatever reason. Either dividends were paid, those would have gone to retained earnings. If after acquisition, dividends were paid and we're now, let's say, on the 30th of June 2025. We're in the future. We work in the future here. So your share capital, your retained earnings form part of your at acquisition line items. In the next video, I'll discuss the since column, and I'll also discuss the fair valuing of financial assets, or fair valuing of assets rather, in the business. And I'll also be discussing intra-group transactions. So you better keep your eye focused on this channel just for a bit. So in order to draw an analysis of equity, you take the fact pattern given to you. There are 80,000 shares, because it's an analysis of equity. It's not an analysis of assets. It's an analysis of equity. So these are the two things of S you have to take into account. But you do not take into account the 11,000. Why? Because that is not the retained earnings at acquisition. So your 80,000 literally comes from your total column, going 80,000, your 7,500, which was your retained earnings on acquisition, giving you total net assets of 87,000 Rand 500. Then we know that P Limited acquired 80% of it. So you're just going to multiply your 80,000 by 80%, your retained earnings by 80% to get to your 70,000. Now, this is an exam technique I learned a bit too late, but I always put my total net assets and my consideration and NCI in two separate line items, as opposed to trying to work back to calculate either the goodwill or the gain on bargain purchase. Because you know that the difference between your consideration and NCI and your net identifiable assets is your goodwill or gain on bargain purchase. So put them in two separate line items, and the difference between the two is what goes here. Obviously, in this circumstance, if we had goodwill, 100% would have gone to P Limited. Why? Because NCI is measured at its proportionate share and not at fair value. So that's how you draw an analysis of equity. I have all this information. It's just me breaking it down into a tabular format. So I did mention the since acquisition part, and I did mention the fact that you need to have a total for the net identifiable assets and the consideration and NCI. So how do we translate this AOE into the journal? First and foremost, I'd use the totals. That's the easiest way to put it. So the total at acquisition is 70,000 Rand for P Limited. Guess what the investment in S Limited is? It's 70,000 Rand. And that's why I told you this total net identifiable assets column is very important. NCI, 17,500. Retained earnings is equal to 7,500. Where would we have gotten that from? We would have gotten that from the actual scenario of 7,500, and your share capital being your first total is 80,000. So this total, what you are doing at acquisition is that you are taking this total and you are splitting it and de-recognizing your investment and recognizing non-controlling interest. Obviously, you have your narration always in order for you to get that 1 mark. Now, for the next video, there are 3 types of intragroup transactions that I'm going to cover. The first one would be loans between group companies. Loans would be eliminated, but also remember that transaction costs will be eliminated, that trade receivable or the credit to bank will be eliminated by the parent, and the trade payable or the debit to bank will be eliminated by the subsidiary. The second one is inventory. So I need us to think of inventory in the sense of there are upstream transactions. Upstream transactions, think of upstream. It's literally going up. It's from the subsidiary to the parent. And there are also downstream transactions where the parent sells to the subsidiary. So as homework, I'd like you to think about the closing and opening inventories and when to de-recognize the unrealized profit from the closing inventories and recognize the current realized profit from the opening inventories. I'll walk you through it. Do not worry. But it obviously has deferred tax consequences. And the last one is non-depreciable property sold. So that would be things such as land or depreciable property, plant, and equipment being sold. So that would be something such as PPE, and you'd have to recalculate the depreciation. The depreciable PPE would obviously carry deferred tax implications, but land will likely be exempt in terms of section IS 12.15. And that's your homework. Everybody, thank you so much for listening to this video and stay safe. Bye.